can you just maybe outline for us this fear of missing out, and why is that a key risk for you?
A lot of the event has happened in China. I think both you and Yvonne mentioned early in the show and in other times that Chinese capital markets has gone through a series of consolidations in regulation, in consolidations, and now we see kind of like sentiment relief rallies in the market. But it does take quite a lot of the catalyst, if I may say, on investors' list to have them more confident and comfortable to come back to the market. That's number one. Number two is the kind of a sentiment relief I mentioned early on, a lot of the policies clarity provided by the Chinese government. Now the markets start to see rally and rebound. Obviously, quite a quick rebound, in my opinion, and particularly if you see just November returns, it's probably the best a month return, for instance, for Chinese internet companies in history. So this kind of rally, investors may feel like I need more clarity, confidence, but on the other side, the market has already rallied alongside with the clarity provided to certain issues that used to be a hurdle or potential issues that challenge China's growth, but now you had the clarity, market starts to react and rally on top of that. And if you remember, probably during the year. Sorry, Yvonne, go ahead.
You're not seeing, how much conviction, you talk about this reopening trade, how much momentum is there still? It doesn't seem like people are fully willing to jump on and say they're overweight on China here right now. But maybe you still have to be pretty cautious going in because the volatility is just insane these days. What are you seeing in terms of flows from your end?
Flow has been strong. Flow has been strong into China for a very simple reason. Yvonne, you touched base on it, is the underweight to China. Overall, both active managers, global mandates, Asia mandate, EM mandate, you name it, they have been broadly underweight China, over the years, over many years. And during peak of the regulation impact of COVID, and you mentioned real estate issues, is they have been actively underweight China even further. So this kind of catch up in one strategically, second tactically has made them, got to catch up in certain ways. But the flows has been strong purely because of a strategic underweight to this asset class. Now, portfolio managers just are catching up slightly, even not close to neutral per se. How much momentum does this reopening trade still have? In my opinion, still have quite a lot. For a very simple reason. The clarity is on COVID. You got to watch and see how the local government are going to implement the policies that they announced by the central government, number one. Number two, dear to Chinese government's, Chinese growth, very core issue is demand side. What is the Chinese government going to do on helping on the demand side? Stimulus consumption, help the investors, help the worker back on track for job, and particularly now is a seasonal rally, potentially consumer spendings and sales numbers. You probably see a bit of seasonal pickup. So I do say it's a lot of still in pipeline, particularly on policy front. The Economic Working Group meeting in just a few days' time. Now, President Xi Jinping is traveling internationally or have been traveling internationally. The deal has been signed. So it's a lot of momentum to see how Chinese corporates will pick up international investments and also go outside of China.
Right.
So I see a lot in the pipeline.
Well, since you talked about momentum there, I'll use your K-Web, as an example of how much momentum or how much further this rally can go. We peaked at about 103 back in early 2021. When do you think we get back to the peak? Is that a 3-4 year story?
I think because of the underlying company impacted their performance over probably dividend, like you rightly pointed out, from earlier 2021, to very much of the earlier this year, in February, March, when the fund bottomed, was mainly driven, macro factor driven. One is when is China going to reopen? We got that clarity clarified. Second is Chinese internet regulation behind ours? from what we read of the work report at CCP Congress that Xi Jinping delivered, the work report we led us to believe it is the case. And a couple of senior officials from China has come out and announced now they want the corporates to implement and rectify and move forward. So led us to believe regulatory reform factor behind us. Second. Third, most importantly, is the underlying companies are consolidating and moving forward from where they are impacted. The answer is yes, if you look at each of the companies that are invested. So I do think we hope now the fund has rebounded just from 11th of November when we first heard the relaxation of a COVID policy to now 20+%. Is it all done?
Yeah.
Absolutely. Is the fundamentals are still looking alarmingly cheap, David and Yvonne. It's 3 standard deviation below 10 years mean. So we think it still have a lot of upside to run from here.
Okay, you're looking at, in terms of where we could still see some upside, consumer power, modernized society. Maybe explain a little bit what that is. And you mentioned about getting into some of these very still beaten up sectors like internet.
Yeah, I think, Xi Jinping set a very ambitious goal for China to become a modernized society. Based on that, just economically, China probably need a 4 to 5% GDP growth from now for another decade. So in that instance, you will see a lot of initiative along the way to continue to progress. One main theme would be urbanization. China has gone through a series of urbanization since 1980s when China started to open and reform policies. You see almost 20 million people move to cities from 1990s since then, So today, China has 870 million people living in cities. That urbanization rate today is sitting somewhere around just above 60%. The modernized society would mean China would have to catch up and meet with the global or even more developed market standards. That's somewhere around 80 to 85%. Just on that, people to move to cities, 25% of 1.4 billion people, that's 250 million people, just use as a comparison, that's entire United States population to be moved to cities. So just that trend urbanization that we continue to see strong continuation and catalyst and still, long momentum for Chinese consumers still come to the market and play. So that's our strategic catalyst for investors to say, if I don't have allocation to China today, this is a time to think more.
Very quickly, my question then to you is, if you look back in time, long-term returns on this market, if you look back to the early 90s, it made sense to be underweight China. Why do you think that changes? U.S. equities have massively outperformed over the long term. I can even pick out other EMs, for example. Why do you think this changes moving forward?
It's probably 2 or 3 things. Number one, David, I think most important is Chinese economic rebalancing. What do I mean by that is in 2010, 2013, those are crucial period for China when, as a country has rebalanced from industrial driven to service driven. So now as a result, you see more corporates, more drivers that rebalance the Chinese economy to service driven to become available to public exchanges, public domains. So now the stocks listed across the world in China, particularly offshore, that gets so overbeaten over the last 18, 24 months, are the corporates, are the service-driven names. Those names is available now, but wasn't available 10 years ago. So now you have a bit of a balanced representation across sectors, across corporates, across state-owned and non-state-owned in the equity markets in China, onshore and offshore. Yeah. So now the equity market is probably more reflective of how China's growth drivers are truly is, and investors probably can benefit from it more than before.